Okay, so picking up where we left off, here are the 5 profitability ratios. And this pen's not quite as good, but we'll see what we can get here. So the first one is profit margin ratio, and we've actually I think seen this before. Hold on, I don't want red. So this is your net income divided by your net sales revenue. So if we did, there goes that thing. If we did a vertical analysis in here, we would have seen this because it's a percent of net sales revenue. So revenue. So what this tells us is, and this is a very common ratio, the percent of each dollar earned as revenue, and we see that as profit or net income. So sorry, sorry, as net income or as profit. So basically, for every sales dollar you earn, how much of that do you get to keep in profit? So if you get a 0.4 here, that means every sales dollar you earn, you get to keep 40% of that as your profit or your net income. That's basically what this one tells you. So higher is better. That's what we want. We want to keep more of it as profit. Another one there is rate of return on total assets. So you take your net income, you add back in the interest expense that you subtracted out, and then you divide that by average total assets. Remember, every time we do average, it's the beginning plus the ending divided by 2. Now, what this one tells you, this is used to evaluate your investments regardless of how they were financed. Regardless of how financed. That's why we add back in the interest expense. So if you remember, we did that problem a little while, a couple chapters ago, and we looked at financing a project through debt versus through equity. And if we did it through debt, we had interest expense, which then affected our taxes and all that. And if we financed it through issuing stock or through equity, it didn't. So the fact that we add back in the interest expense, that's how we're going to evaluate that asset, whether it was, because it'll change, how you finance it. So we add that back in to kind of take that out. So to remove that element of how it was financed. And so we're just evaluating the asset on its own merit. So just like the other one, higher is better. And then we have an asset turnover ratio. So this is net sales revenue divided by average total assets. Same number we got there, beginning plus the ending divided by 2. So this is how, and I think we've looked at this one before, how effectively your assets are used to generate revenue. So if they are like investment assets, like stocks and bonds, how much income are they generating? It can relate to your productive assets as well. This is usually related to your gross profit margin, like they're both high or they're both low. And again, higher is better. We want a higher one here. And these last two, I believe we looked at in chapter 15, so I'll go over those just briefly. Rate of return on common stockholders' equity. So this is your net income minus any preferred dividends if you paid them. And then you divide that by your average common stock equity. If you don't have preferred, then you're just dividing this by your total equity here, which would include your retained earnings. Again, this will have to do with what they're, if they're financing their stuff through debt or equity, that'll change this ratio here. How much income is earned per dollar invested? Is kind of what that one tells you. And then the last one here, earnings per share. Again, it's that net income minus preferred dividends, if you have them, divided by the number of shares of common stock. Outstanding. So one is taking net income divided by equity, and then one is taking net income divided by the number of shares. So the earnings that the company's making, the earnings per share. So let's highlight those formulas, and this one and this one. All right. So let's look at a couple of those. The first one we have is they want the profit margin. Now, this is going to go back to those statements. So let's fill in our little formulas, and then we'll go back to the statement one, so I don't have to keep flipping back and forth and make everybody car sick. So profit margin ratio is net income divided by net sales revenue, return on assets is net income plus interest expense divided by average total assets. Number 3 is the asset turnover ratio, which is net sales divided by average total assets. And then number 4 is return on equity, which is going to be net income plus or minus your preferred dividend. Sorry. Is that what I said in the last one? Let me make sure I wrote that. Oops. Nope, don't want that. Sorry. I'm on a different tablet and it doesn't work quite as well for me. Minus preferred dividends divided by average common stock equity. Yeah, I did minus. Okay, so if we go, oh, here it is. Back to this guy. So this is what I'm looking for. So I need this net income number. I need this interest. I need net sales revenue. When it asks for average total assets, I'm going to average these two together. When it's asking for common stock equity, I'm going to be looking at this number right here because they don't have preferred stock. What else am I looking at there? So net sales revenue, net income, the interest expense we need for the return on assets. I think that's everybody. So those are the ones we're going to use. You're just going to have to trust me that I get it right here. Or you can have it in front of you while you're doing this on the other sheet to use that. So net income is $7,300. And net sales revenue was $40,600. So that gives us 0.18 or 18%. So for every dollar in sales, they get 18 cents in profit is basically what that one tells you. The next one, the net income was $7,300. The interest expense was $600. So because we subtracted that out, we're adding that back in. The assets were 82.8 was the beginning. The ending was 54.2. So I'll add those together and divide by 2 to get an average. So then I get 7,900 divided by this average comes out to 68.5, and that gives us 0.115 or 11.5%. Net sales we said was 40,600, and we just figured out average total assets here. That's 68.5, so we don't need to figure that out again. And that gives us 0.593. This one doesn't have the handy eraser on it, so it's a little bit 593 times. And then for the last one, the net income minus preferred. They don't have any preferred dividends, so this will just be the net income 7,300 minus 0. Average common stockholders' equity. So beginning equity was 40,900. Ending total equity was 30,700. So I get 7,300 divided by the average equity is 35.8. And that equals 20.4%. So there's those. We're going to go back to the earnings per share on the next one, sort of, because it's sort of related. So all of these, if you notice, are net income as a percent of something. That's why these are the profitability measures. So net income as a percent of sales, net income as a percent of assets, net income as a percent of equity. So that's why these are the profitability ones, even though some of them relate to equity. Okay, so the last group here are our stock ones. Again, I think we looked at a lot of these in chapter 15. Price earnings is the market price per share divided by the earnings per share, which we did here 2 slides ago. Okay, so once you get the earnings per share, you can do the PE ratio, which is a very common one. What this one really tells us is the stock market's value of the company earnings. So not just how much the company earned, but this one really tells us what the stock market thinks of this company. So even though their earnings might be low, if the stock market is very excited about what this firm can do, then we would see this in we would see this maybe be higher than you would normally see in just the income stuff. Dividend yield is the annual dividend per share divided by the market price per share. It's the percent of the stock market price. So what stockholders paid for it, how much of that is returned to the stockholders as dividend. That's what this one tells you. So percent of the stock market price, what the stockholders actually paid for it, market price, that is returned to the stockholders as dividends. Returned to stockholders as dividends. This one, and along with the next one, is a very important one if your goal is dividend. Remember we talked about there's 2 reasons people buy stock. They either want to get dividend revenue from it, or they want to earn on the they want to buy low, sell high, and earn a profit on the sale of it. So this will help people decide. So this is very important if your goal is to to earn dividend revenue. If that's the reason you're buying the stock, then you would want somebody with a high dividend yield. On the same hand, if you want somebody that is not paying out dividends, and because you want them to keep reinvesting that and increase the value of the stock, then you might specifically look for somebody with a low dividend yield. Along those same lines, the dividend payout is the annual dividend per share divided by the earnings per share. And this tells you the percent of the company's earnings that are paid to common stockholders as dividends. So again, preferred stockholders might be more interested in the dividend yield, whereas common stockholders may be interested more in that dividend payout. So let's highlight these and go back to a couple of these. So we're going to calculate the earnings per share, the PE ratio, and what does this mean? So earnings per share, which was actually a couple slides ago, but that is the net income minus any preferred dividends, which we don't have, divided by the average, goodness gracious, the average common shares outstanding. Shares outstanding. So our net income was $7,300. We had 0 in preferred dividends, and it told us back, there was just like a little note at the bottom of that in the balance sheet saying that they had 10,000 shares. And if we, I'll just flip back here. So they told us they had 10,000 shares in common stock, and you can see right here that nothing changed. And so that means, because really if it changed, you would have to figure out how many you had at the end of 2017, and then average them the two together. But since there was no change in that, we know they didn't issue any more shares. So so it's just 10,000, because they didn't issue any during this time. But if they had, you would have to average the two together. So this will just be 10,000 is my average since it didn't change. If you really wanted to, you could say 10,000 plus 10,000 divided by 2, and you're going to get 10,000. So we get 73 cents per share. Now that we have that, we can calculate the price earnings ratio, which is the market price per share. Oh, goodness. Per share divided by the earnings per share. So they told us up here that the market price per share was $12.50. The earnings per share is 0.73. So we get 17.12, which is pretty high. So that says their profitability is pretty good. Again, you can look in the chapter if you want just a little bit more about what some of these mean. I feel like most ratios really only mean something if you compare it to something else. But some of them in this text, they will say this is good, this is high, this is low, something like that, just to give you a ballpark figure. But so many of them vary so much. What you would really do with the price earnings ratio is, if you're comparing two different stocks from two different companies that you're looking at investing in, you would want the one with the highest PE ratio. The last thing in here is just some red flags to look for. Signals that a company could be in financial trouble. So, for example, sales, inventory, and receivables all usually move in the same direction. So they're all going up or they're all going down. If you were to see something like their receivables are going up, but their sales aren't, that might be kind of a red flag. That's kind of says they're not collecting maybe. So if they're all going down, that's bad. If they start moving in different directions, that might be a concern. You might want to look at that. Earnings problems, if any of these kind of profitability ones are starting to go down. Decreased cash flow. If we go back to the statement of cash flows, if you see a company where their cash flows from operating is less than their net income, that would be a big red flag. It doesn't mean, I would never touch this company, but if it was me, I would want to look a little bit more here. I mean, a lot of these ratios, no one ratio can tell you the whole story. You have to put a lot of this together. But that would be a big red flag. Too much debt is always a problem. That's why we have debt ratios. But also, too little debt could also be a problem. And this will depend on the type of firm. So if you're a service business, maybe you're not going to have as much debt. But if you are a big manufacturing firm with a lot of fixed assets, if you have no debt at all, it probably means that your equipment is really outdated because you're not keeping up with technological advances and not replacing worn out equipment and that kind of stuff. So for certain firms, a certain amount of debt is expected, and you would sort of need that really to keep up. And so if that firm didn't have any debt at all, I would be concerned that they're really antiquated, which means they're not going to be able to keep up with their competitors. It means their costs are going to be higher because they're not investing in the new technology, and they're not going to be competitive for long. So, but again, it's going to vary on the type of industry. The inability to collect your receivables. If you're not collecting on your receivables, that could definitely point to future cash flow problems. So maybe look at the credit terms, maybe look at, to whom they're offering credit, all that kind of stuff. And again, if inventories are building up, that says they're not buying the right things. They're not buying what people want, and so that means they're going to have trouble selling them. So those are just kind of some things to look for. And then the last 3 slides on here are just all of the ratios we did that are going to be a little bit more legible than mine, and you got a little explanations over there on the side. So that's all of those. All right, there we go.